What if I told you that a group of ordinary people with no prior trading experience were taught a secret system that made them millions? This isn't a Hollywood movie plot. It's the true story of the turtle traders. In the early 1980s, two legendary commodity traders, Dennis and William Echart, had a debate. Dennis believed anyone could be taught to trade successfully, while Echart argued that great traders were born, not made. To settle it, they ran a radical experiment. They recruited a diverse group of people, a professional gambler, a security guard, even a fantasy game designer, and taught them a specific set of trading rules. The results were staggering. These novices, nicknamed the Turtles, went on to earn over $175 million in just a few years. So, what was their secret? And more importantly, can their methods still work today? Let's dive into the fascinating world of The Complete Turtle Trader by Michael Kovville and uncover the principles that turned everyday people into Wall Street legends. The core of the turtle experiment was a simple yet powerful idea. Trading can be a system, a set of mechanical rules that, if followed with discipline, can lead to massive success. Dennis believed that emotions, gut feelings, and ego were the biggest enemies of a trader. His system was designed to remove those variables entirely. It was a complete, trend-following strategy. This means they didn't try to predict where the market was going. They didn't care about a company's earnings reports or the latest news headlines. Their only job was to identify a trend, whether up or down, and ride it for as long as it lasted. Think of it like surfing. A surfer doesn't create the wave. They wait for the right one, get on, and ride it until it fizzles out. The turtles did the same with market trends. So, what were these secret rules? Covel's book lays them out in detail. The system had two main components: breakouts and position sizing. First, the entry signal, or the breakout. The turtles would enter a trade when a price broke above its highest point, or below its lowest point over a specific period, usually 20 or 55 days. For example, if a stock's price hadn't gone above $100 in the last 20 days, the moment it hit $100.01, that was a buy signal. They weren't buying low and selling high in the traditional sense. They were buying high and hoping to sell even higher, catching the momentum of a new upward trend. The same logic applied in reverse for shorting a market, selling when the price broke below its recent lows. This might sound simple, but here's where the genius comes in: risk management. This was the second and arguably most crucial part of the system. The turtles didn't just blindly throw money at every breakout. They used a sophisticated position sizing model based on market volatility. They calculated something called N, which stood for the average true range of a market over the last 20 days. In simple terms, N was a measure of how much a market typically moved in a day. Every trade they took was sized based on this N value, ensuring that a 1N move against them would only result in a 1% loss of their total account. This meant they were risking the exact same small percentage of their capital on every single trade, regardless of whether they were trading volatile oil futures or slower-moving currencies. This is a game changer. It standardized risk across all markets and prevented a single bad trade from wiping them out. Let's talk about the exits, because knowing when to get out is just as important as knowing when to get in. The turtles had strict rules for cutting losses. Their stop loss was typically set at 2 N values away from their entry price. So, if a trade went against them by a predetermined amount, they were out. No questions asked, no hoping for a turnaround. This disciplined approach is what separated them from amateur traders who let small losses turn into catastrophic ones. On the flip side, their rules for taking profits were designed to let their winners run. They would exit a winning trade only when the price crossed a 10-day or 20-day low. This simple rule forced them to stay in a trend for as long as possible, capturing those huge, home-run trades that generated the bulk of their profits. Now, this is where the psychological challenge comes in. The turtle system has a relatively low win rate. Most of their trades were small losers. They might lose on 60 or even 70% of their trades. Can you imagine the mental fortitude it takes to stick to a system that is wrong most of the time? This is why discipline was the #1 trait Dennis looked for. The turtles had to trust the system, knowing that the few massive winners would more than make up for the many small losses. It's a classic example of the Pareto principle, or the 80-20 rule, where a small number of trades generate the majority of the profits. This is a tough pill for most people to swallow. We're wired to want to be right all the time. But the turtles proved that in trading, it's not about being right. It's about how much you make when you're right versus how much you lose when you're wrong. So, can you become a turtle trader today? The principles are timeless. The markets have changed, they're faster, more electronic, but human psychology and the nature of trends have not. The core lessons are more relevant than ever. First, you need a system, a set of objective, testable rules for entering, exiting, and managing risk. Don't trade on a whim or a hot tip. Second, manage your risk obsessively. Know exactly how much you're willing to lose on any single trade before you even enter it. Position sizing is your shield. Third, be disciplined. Your system is useless if you don't follow it. You must have the conviction to execute your plan flawlessly, especially when it feels uncomfortable. And finally, think long-term. Trend following isn't a get-rich-quick scheme. It involves long periods of small losses or drawdowns, punctuated by massive gains. You have to have the patience to weather the storms to enjoy the sunshine. The story of the turtle traders is a powerful testament to what's possible when you combine a solid strategy with unwavering discipline. It demystifies trading, transforming it from a mystical art into a learnable science. Richard Dennis won his bet in spectacular fashion, proving that with the right rules and the right mindset, you can indeed manufacture super traders. The question is, do you have what it takes to follow the rules? Thank you so much for joining me on this deep dive into the world of the turtle traders. If you found this breakdown valuable and want to learn more about trading systems and market psychology, make sure to hit that like button and subscribe to the channel. Let me know in the comments what you think. Could you trade like a turtle? Until next time, trade smart and stay disciplined.